Welcome to the Zawya Podcast. This is Noha Al-Hinnawi, and today I'm speaking to James Swanston from Capital Economics. Swanston is the think tank's lead economist covering the Middle East and North Africa. From his office in London, he's sharing with us his views on the economic situation in Egypt, particularly on the likelihood of sovereign default, inflation, and the foreign currency shortage. For long, Capital Economics had downplayed the likelihood of Egypt's sovereign default. However, recently you released this report where you sounded the alarm that sovereign default is not necessarily a very remote probability. What's behind this change in your view?
I think what's changed most recently with Egypt's risk of sovereign default is that is simply what's going on with the pound and the lack of commitment to this orthodox economic policymaking shift. So the pound has been this de facto peg since almost January now, and recently with the news that there'll be the election for the presidency in December, it looks like it could even be held until that's over with. The risk there is that this is just building things up the more it's held on to, so it could risk an even sharper adjustment with the currency, and given that around a quarter of Egypt's government debt is denominated in foreign currency, that leaves it vulnerable to those further falls in the currency. And there's also the risk as well of how far interest rates have risen in Egypt, both on their dollar bonds but also on local currency bonds as well. So there is that risk as well of how fast those increases in interest rate pass through into debt servicing costs. So those are the key risks in terms of what sort of made the possibility of a sovereign default more likely. I would say possibly against that is that there is still this firm commitment to a tight fiscal policy. They're still running a primary balance surplus, and the budget they've laid out for the fiscal year 2023-2024 has certainly reaffirmed that with aiming to increase the primary surplus to 2.5% of GDP. So there is at least that base commitment to tight fiscal policy, but there are those risks, as I previously mentioned.
The government has recently announced that the presidential election will be held in mid-December. How is this development expected to impact the country's economic trajectory in the short term?
I think in terms of how the announcement of the election changes any sort of the trajectory, I think there had been these swirling rumours that it could have been brought forward from when it was supposed to be held next year. And there had been previous sounding outs from officials as well as the finance minister in various briefings where they'd spoken about how the falls in the pound and the subsequent increase in inflation has hit the Egyptian households quite severely in terms of what it's meant for the cost of living. So I think they were very conscious of what another devaluation of the pound, which is ultimately needed in both our view but also that of the IMF and what investors think needs to happen as well. So at least bringing the presidential election forward and giving it that firm date for mid-December, it does provide that possible reassurance that there will be a policy move after that, because once there is what is almost sort of certainly going to be the case that President al-Sisi is re-elected as president, that they will make any policy moves after that because of securing his future within the presidency, and then that being possible that the devaluation that comes with that is ultimately what is needed, and they commit to a flexible exchange rate regime. And yes, there'll be economic pain, but it's the sort of medicine that Egypt's economy has needed for a long time.
What's the economic cost of delaying the devaluation of the Egyptian pound until after the election?
Yeah, so the cost of delaying this devaluation is what it's doing with investors and the uncertainty that it's created. So what we're seeing in terms of the spread of sovereign dollar bond yields over US treasuries, they're still floating around that sort of 1,200 basis point mark, which is normally the well above the threshold of around 1,000 basis points, where we consider that debt is distressed. Obviously, the pass-through of that is that this is if they were any need to issue debt or roll over debt on foreign currency terms, that it would increase the cost of servicing that debt. But also, it's more that it's struggling to attract the capital inflows that Egypt so desperately needs. So foreign currency reserves at the central bank are still very low. The inflow of capital into things like local treasury bonds hasn't been to the levels that we'd seen previously. And Egypt more generally just needs to attract this capital inflow as part of the privatization drive. And also, it actually helps to support the currency in the long term. So even if they were to announce any sort of devaluation, at the very least, it might reassure investors that, okay, this is the real deal this time around. They're committing to a flexible exchange rate. Yes, it's going to fall sharply, possibly at the initial devaluation, but after that, there's a lot more certainty that can be provided around a flexible exchange rate, that it's more, it can be more determined by demand and supply rather than being fixed by the central bank. So they're the key things, and the costs. The risk is that the longer they hold on to it, it lets these sort of external strains build up within Egypt's economy, and could risk that an even sharper devaluation is needed initially, and obviously the cost of that then being much higher inflation, the need for more aggressive interest rate hikes than otherwise might be the case. If they delayed it even beyond, delaying it to December is one thing, but delaying it already is probably going to mean that the adjustment we're going to get is going to be more than what might have been the case if, say, they had announced any sort of currency move in October or even before then. It's worth bearing in mind that it was October last year when they got the staff level agreement for Egypt's current IMF deal, and they announced this intention to move to a flexible exchange rate regime, and that hasn't materialised. So this delay has been ongoing for almost a year. So we're seeing this with the step devaluations we've had, that it could be a sort of more sharper devaluation in, say, it is to come in December than might have been the case if it had come this month or the next month's central bank meeting, for example.
In your opinion, what's the real value of the Egyptian pound?
We've currently penciled in that the pound needs to devalue to about 35 to the dollar, so that's about a 12% fall versus the dollar from where it currently stands. And it's worth bearing in mind that that's sort of not even as far as it sits on the parallel market, where the pound is trading at over 40 to the dollar. So there is possibly the risk that it falls beyond our forecast.
What are your inflation projections for the rest of 2023 and for 2024?
So in terms of our inflation projections, we have the headline inflation rate rising a little further in September and October when those data come out. So it could touch up about 40% year on year. So that's only a small increase in terms of a percentage point change from where it currently where it stood in August at 37.4%. And then after that, even if there is this devaluation of the pound to come to fall under 12% to 35 to the dollar, if we were to expect, in terms of what that actually means for inflation, it still means that the inflation rate itself will begin to fall back. So it will keep it a bit more elevated for longer, but we still think that inflation will fall back in 2024. And we've currently got the expectation that inflation will average about 14% in 2024, and will actually, toward the end of next year, start to fall back within the Central Bank of Egypt's inflation target range of 7 plus or minus 2%.
How can it fall back to a single-digit percentage next year?
And part of that is just reflecting the base effects of previous increases. So the falls in the pound that we've seen so far have obviously, it's fallen about 50% compared to where it was in March 2022. So those will start to fall out in terms of base effects, in terms of the headline inflation rate. We've also seen things such as the spillovers from the war in Ukraine, other impacts in terms of wheat prices with the end of the Black Sea grain deal that have pushed up inflation. Assuming any of those sort of risks didn't occur again, those base effects will fall out of the annual comparison. So all of this sort of put together, as well as the possibility that oil prices are slightly weaker next year, this is part of our expectation of why the headline rate will fall back next year, even with where it currently stands at, and could rise to nearly 40% by the end of this year.
In 2016, Egypt embarked on this economic restructuring program that was backed by the IMF. Egypt was hoping to rebuild its foreign reserves, to reduce the financing gap and all of that. Now in 2023, we're back to square one, facing the same challenges: widening financing gap, dwindling reserves, shortage of foreign currency. In your opinion, is it enough to blame external shocks for this situation?
I think that for their part, there is some of the effects of the pandemic and the subsequent shock from the war in Ukraine in terms of exacerbating external strains within Egypt's economy. But I think the key point and key word there is exacerbating, is that these strains already existed within Egypt's economy, and it was part of the mismanagement of parts of the Egyptian economy. I think they did do some good things from the back off the back of the 2016 IMF deal. They tightened fiscal policy very aggressively, from flipping a primary balance from quite a large deficit into a surplus quite quickly. And they would try to restore macro stability in that end with adopting an inflation targeting framework. They brought down inflation if you remember back to post 2016 IMF deal. But the parts that were left unaddressed, I think, what are the key things here. And the main one of that is what happened with the pound. The central bank realistically held on to the pound for far too long. There were some small step devaluations after the 2016 sharp devaluation when it fell 50% against the dollar, but nothing major. And I think if you think back to March 2022, in the sort of 18 months before then, the pound had basically been held completely steady at about 15.6 to 15.7 to the dollar. And this is in the midst of a global pandemic when Egypt, which has reliance on tourism, for example, it was vulnerable to the sort of shutdown of economies, and also the effects of sort of international prices, etc. These were all things where you would expect otherwise that the pound would have adjusted. It would have weakened, all else being equal, against the dollar. But that just didn't happen. The central bank held on to the pound, continued to try and rebuild its foreign exchange reserves. And then they just got the sort of second hit, as it were, of the war in Ukraine that really tipped the balance and has led to the sort of situation we're in now, where they've gone back to the IMF, they've depleted foreign exchange reserves in order to try and support the currency, and they've had to devalue the pound multiple times since. So that's one of the key things, I guess, and we are in this position again of, is this time really any different? And that's the question. And I think that's what investors are really worried about, and I think the IMF as well, with the delays to the reviews of its deal, is we haven't seen that commitment once again to adopting a flexible exchange rate regime.
Some observers contend that the government's large spending on mega projects, which they deem unnecessary, has contributed immensely to the country's growing financing gap and to the situation we're in today. To what extent do you agree with this view?
I think there's certainly a case where there's possibly been a misallocation of resources from the government's side of things in terms of where it's spent its money, and obviously then that's not been able to tighten fiscal policy as much as they otherwise could have. If they hadn't spent on these mega projects, they could have saved this money for a rainy day, paid down debt when it was more expensive to do so, but they also could have put it toward more productive methods of government spending. So we've argued in reports that in terms of unlocking the sort of the real sort of potential that Egypt's economy has in the longer run, things like education, improving the business environment, trying to improve the sort of flexibility of the labour market, they're all key things where maybe there has been a lack of government expenditure to try and address these, particularly on the education front. So I think that's something where that money could have been spent better, but there's also a case that the money could not have otherwise been spent at all, and put them in a much sort of better position now. But I think in terms of the sort of pillars we like to think of how the IMF views Egypt, fiscal policy and government spending is probably one of the actual areas where Egypt looks pretty good from the IMF's perspective. How they have on the grand scheme of things tightened fiscal policy. They've got the debt position that, while it has risen, that all else being equal, it should be on a sort of downward trajectory over the coming years. And they have also more recently tried to reinvigorate the sort of privatisation drive and reducing the footprint of the state and the military within the local economy. So there are at least positives on those fronts. But there is obviously, as I said, a case to be said for the misallocation of resources towards mega projects in Egypt.
Back to the issue of sovereign default. Some are arguing that neither multilateral partners nor regional allies would let Egypt default on its foreign debt given its geopolitical weight. Do you agree with that?
In terms of our central view at Capital Economics, we are still of the view that Egypt will avert a default. It's just that the path to avoid a default is getting narrower. But I think certainly the support from the Gulf states, following the outbreak of war in Ukraine, Egypt did initially turn to the Gulf in terms of looking for external support. So the Saudi Arabia, UAE and Qatar deposited reserves at the central bank, which obviously have helped, all else being equal, in terms of ensuring that there was macro stability and that they could there wasn't major external strains and the pound didn't have to fall even sharper. And also many of the sovereign wealth funds within these countries are the partners for, or seeking to be partners in terms of the privatization drive within Egypt. And then on the other side of it is the sort of multilateral side of things. With the IMF has obviously got a deal with Egypt, and it's just while the reviews are delayed, it's still providing that support. And historically, it's also worth bearing in mind that Egypt has always been this sort of poster child for the IMF. It's sort of been one of its sort of better examples it's put forward of how structural adjustment programs have been a success in restoring macro stability across the sort of developing world. So I think, and that's also part of also the foreign policy side of things, with how important the US is with regards to IMF voting shares. So it all plays its part, and I think why ultimately it will play its part in why Egypt avoids a default, but it's certainly playing a precarious line of trying to avoid a default. It's certainly not sustainable in the long run. Egypt eventually should try to wean itself off of this level of support. It's one of the countries that has had the most IMF deals historically, and it's borrowed quite a bit above its in terms of its quota. And obviously with the Gulf support as well, is that as I said, there's about $13 billion approximately that's been deposited at the central bank, and while there's nowhere sort of near to be a sort of rollover risk that they were to withdraw those deposits at the central bank of Egypt does need to sort of make up that hole otherwise, because while there isn't that risk, obviously they need to have a healthy level of foreign exchange reserve. So being able to wean themselves off that support in the long run is critical, and it also would ensure that Egypt reverts back to having macro stability itself, that it's governed properly, and that it can adjust to these external shocks itself a bit more easily, rather than every sort of unexpected turn it has to turn to the IMF or turn to the Gulf states.
Just to follow up on the Gulf support, this support has recently become a bit shaky. We didn't see any strong engagement from the side of Gulf investors with Egypt's privatization program. How would you comment on that?
Yeah, in terms of the Gulf support, yes, there has been, I'd say, some wavering of that support, I'd say, over the past year. I think the Gulf, like many investors, is just waiting to see what happens with the pound. I think ultimately they do have those deposits at the central bank. They are going to continue to provide support to Egypt in terms of any soft power play. They want to continue to support al-Sisi's regime. If you think back to the Arab Spring and the support they provided then, so they are keen to provide that support. But in terms of furthering the privatization drive and the Gulf's support of that, they, like any investor, will want to see that their investment isn't lost. If they were to invest now and then suddenly the pound is to be devalued, then they'll lose some of that investment. So I think they're waiting for that currency move, like other investors around the world.
Thank you so much for talking to us. It was a real pleasure.
Yes, no problem at all. Happy to be here.